For more now on the most important things to do with your money during the coronavirus crisis, we're joined by Reid Fraser from Highland Financial Advisors. Reid, thanks for joining me.
You're very welcome. Thanks for having me.
So how are you advising your clients during these volatile times, up and down?
Yeah, a lot of hand-holding. We work with people to design portfolios really for the long term, an engine that's going to help them to meet their goals over the long term. So when events like this happen, the natural tendency is to think that they can, bail out, get out of the market, get back in at the right time. So we've been through this for over 30 years working with people's money, and that biggest risk that most people face, believe it or not, we tell them is not the market, not the coronavirus, but your own behavior with your money, especially in times of fear.
Sure. We saw the market soar just as President Trump declared a national emergency, 1,200 points initially, ending the day 1,900 points up. What do you make of that?
Well, again, it's people buy typically when they think the news is turned. People will sell when they have rumors of news happening. And if there's any indication that the news is going to turn, the information that people are making their decisions on, they will jump right in and start buying. And that's why we tell people it's so hard to time the market. You really are better off sticking with this. There was a time when, a few days ago, when it looked a lot more dire than it does now. And on a total return basis, from January 19th, the S&P 500 at the close today is probably down around 15 to 16%. On a price basis, it's down around 8.3% from the height. But a turnaround could happen in 2 or 3 days. And if you're not in the market, you could miss that. So.
Do you think we've seen the worst? I mean, this is a pretty bad week. Are we on the upswing here? I mean, are people still fearful of a recession?
I think people are personally are more concerned about the consequences of the coronavirus. I think they're more fearful about the news getting worse. And unfortunately, I think in the U.S., as we start testing more people, I think the numbers are going to get worse before they get better, maybe much worse.
And then the markets are tied to that, right? I mean, if the numbers get worse, our numbers get worse, right?
Yeah, I mean, the trading that's going on, about 80% of the market is traded by professionals, people that are professionally managing money, and they're trying to predict what's going to happen, recession, earnings on companies, things like that. It's very hard when the markets are so volatile to have those algorithms that they're based on. So they may sell, and then investors, common people in their 401k things, they'll start selling because most people are very loss adverse. They're just going to try and protect themselves. And then, of course, the index funds and everything else, the algorithm trading that goes on with those, they have to sell to meet with the market. So you get this domino effect going on. I think we're in times, and I'm talking about from here into the future, where volatility is going to be higher. It's just part of what we live with. The markets work if you just stick with a long-term approach to a diversified portfolio. And for instance, if you have a balanced portfolio of stocks and bonds, you didn't lose as much in these. And you're not down 15, 16% from the high. You're probably down 10, 11% maybe.
Well, the advice has always been stay in it for the long haul, so we'll see how it shakes out long term. Reid Fraser from Highland Financial Advisors, thanks for joining me.
Anytime. Thank you very much.
All right.